Hello everyone. I will cover Chapter 11 in this lecture. This chapter is about bond valuation, and these are some of the concepts that we will cover. So we start with the required return on a bond. So it consists of the risk-free rate and risk premium. So risk premium covers for any default risk, liquidity risk, or call risk. Call risk is related to premature repayment. The risk-free rate consists of the real rate of return and the inflation premium. There are multiple segments in the bond markets. For example, US Treasury, municipal bonds, corporate bonds, and so on. So a different interest rate applies to different segments, and the difference in interest rate between these segments is called the yield spread. So what we notice is municipal bonds are generally 20 to 30% lower interest compared to corporate bonds. That is because of the tax exempt feature. Among municipal bonds, general obligation bonds pay lower interest than revenue bonds. Possibly, it could be due to the revenue bonds paying out of a single project. So there is more risk involved, and hence they pay higher rates. Treasury bonds have lower rates than corporate bonds because they are assumed to have no default risk. These bonds are guaranteed by the federal government, are also exempt from state income taxes. If the bond has lower credit rating, it pays higher interest rate. If the bond has longer maturity, it pays higher interest rate. A callable bond also pays higher interest than a non-callable bond. So what causes the interest rates to change? There are multiple factors. One important factor is inflation. If inflation goes up, the interest rates also go up. Similarly, if inflation declines, the interest rates also decline. So there are other macroeconomic variables which also have a significant impact on interest rates. We'll look into those factors shortly. So if you notice, the trend in inflation is the blue plot, and the trend in interest rate, that is the interest rate for US Treasury bond, that is the red plot. And they both are in sync. So whenever the inflation rate goes up, the interest rate also goes down. The interest rate also goes up, I mean. So these are the other important macroeconomic factors. So if the money supply in the economy increases slowly, that will decrease the interest rates. If the money supply decreases gradually, it will increase the interest rate. So more money supply means more funds are available, so interest rates go down. If money supply decreases, less funds available, so interest rate goes up. If it's a fast increase, so it may lead to inflationary trends, so interest rate goes up. If it's a quick decrease, it could be due to economic downturn, so hence interest rates will go down. If the federal budget has a deficit, then the government needs to borrow money. So less funds are available for other entities, and hence funds are in more demand and interest goes up. Similarly, during surplus, the government has less requirement to borrow, so more funds are available to other entities and interest rate goes down. If the economic activity shows that the economy is expanding, it means that there is more demand for funds, so interest rate goes up. If the economy is going through a recession, there is less demand for funds, so the interest rate goes down. If the Federal Reserve has expansionary policy, that it wants the economy to grow, then the interest rates will go down. So they will bring down the interest so that the funds are easily available to borrowers. Similarly, if the Federal Reserve wants to control the economic growth, or rather to control, they want to control the inflation, because of which they want to tighten economic growth. So they will increase interest rates and make funds more costly. Nowadays, many investors invest in foreign bond markets. So if interest rates rise in foreign bond markets, it also uh, influences the domestic markets to raise interest. Similarly, if foreign interest rates go down, domestic interest rates may also go down. Now we look at term structure. So term structure of interest rate means the relationship between interest rates and the time to maturity for a given bond category. And when we plot this relationship between interest rate and the time to maturity, we get the yield curve. This is a typical example of an yield curve. Different term to maturity of different bonds and their corresponding yield. So when we plot them, we get the yield curve. So what do we notice in the yield curve? It is generally upward sloping. That is, longer maturity bonds pay higher interest as compared to shorter maturity bonds. Sometimes the yield curve may be inverted. That is, shorter maturity pay higher interest than the longer maturity bonds. Sometimes it is flat, that is, the interest rates for short-term and long-term debt are essentially same, and sometimes it is humped. So the intermediate maturity bonds have the highest rates. So when we want to plot the yield curve, so we can take any category of bonds. So let's say the treasury securities, because in this case they are actively traded, so their price and yields at different term to maturity is available. So we can plot the yield versus the time to maturity, and then we will get the yield curve. We can do a similar exercise for other categories of bonds, provided we get sufficient information. So this is the typical yield curve for US Treasury security. This is the tabular format of the previous yield curve. So the yield, if you notice, the yield curve is at different dates. The yield for different term to maturity will change with time, and that reflects at different dates. This is the tabular format of the term structure of interest rate. So what are the underlying reasons for the yield curves, or the underlying reason for the shape of yield curve? So we have three commonly used theories: the expectation hypothesis, liquidity preference theory, and market segmentation theory. So expectation hypothesis says that yield curve reflects investors' expectation about future interest rates. If they expect future interest rates to go up, they will want to purchase short-term bonds, and they will only purchase long-term bonds if these bonds offer higher yields than short-term bonds. Hence, it's an upward sloping yield curve. If they expect interest rates to go down, then they would not like to invest in long-term bonds and earn less interest income. So they would like to invest more on short-term bonds in the expectation that interest may rise in future and they can reinvest and get higher income. So that is why the demand for long-term bonds decreases, and hence short-term bonds tend to offer higher. So it becomes a downward sloping yield curve. Now, if we consider the liquidity preference theory, which says that long-term bonds should have higher interest rate because of the added risk involved. So long-term bonds are less liquid, that they are less frequently traded, and they are uh, subject to more interest rate risk. So the investors demand higher risk premium, and hence it increases the interest rate of long-term bonds. Similarly, from the perspective of borrowers, the borrowers may want to uh, access long-term bonds. So they have access to funds for a long period of time. Otherwise, if they go for short-term bonds, they will have to repay the bond, and then they would have to issue new bonds, new short-term bonds, not knowing what would be the interest rate in future. So they would want more uh, certainty in their cash flows, and hence would settle for long-term bonds. So they are also ready to pay a premium for long-term bonds. So this is the reason why the yield curve is upward sloping. Market segmentation theory looks at the demand and supply of the bonds, and that explains the yield curve shape. So if there is more supply than demand for short-term loans, then the short-term rates will be lower. Similarly, if the demand for long-term loans is more than their supply, the long-term rates will go up. So this leads to an upward sloping curve. So basically, if there is any demand supply mismatch, that will have an impact on the prevailing yields, and that will determine the shape of the yield curve. So which of this theory is more suitable? So all theories are able to explain the yield curve to some extent. For example, if the yield curve is upward slope, first theory says that investors expect interest rates to rise. The second theory says that the lenders prefer shorter maturity loans, so longer maturity debt has to provide higher interest. And the third theory says that there might be greater supply of short-term loans, because of which their uh, interest rate goes down. And this one or more of these reasons explain why there is an upward sloping yield curve. Similarly, for downward sloping yield curve, there are different explanations provided by the different theories. So one or more of these explanations are valid. So why are we looking at the term structure of interest rates, or why are we looking at the yield curve? Because it helps in investment decisions. So the yield curve at any point of time helps us to understand the future trends in interest rates, and that will have an impact on the returns or on the bond prices. So if we expect the yield curve to slope upward, then the investors will expect interest rates to rise in future. So they might want to invest in intermediate maturity bonds, and perhaps reinvest in future in expectation of higher income. So this is one implication of the yield curve. We also need to look at the steepness of the yield curve, that is the difference in yields among the different maturities. So if it's a steep yield curve, it means the market is bullish. So the investors may want to move into long-term securities. If it's a flatter yield curve, that is the difference in yield between different maturities is less. So that reduces the incentive for moving to long-term maturities. So in that case, shorter maturity bonds are in more demand. So this is another implication in terms of the investment decision. So now we look at the pricing of bonds. So bond pricing means the present value of their future cash flows. So the basic valuation model is to consider the periodic interest income and the principal repayment at maturity. And then we find the present value of these two cash flows. The present value of the regular interest payments as well as the present value of the principal or the par value. So to do that, we need to know the coupon rate or the annual coupon payment. We need to know the par value, that is the principal amount, the number of years remaining to maturity, that is the term to maturity, and what is the prevailing interest rate for that bond, that is the yield for the bond. So we use the prevailing yield as the discount rate and find the present value of the two cash flows. That will give us the bond price at a particular time, and bond price at present. So we can do it in Excel or we can use financial calculator. So the first example considered annual compounding by default. We can also do for semi-annual compound. So in this case, we will have double the number of cash flows. The coupon payment will become half, and we will also use half of the market yield as a discount factor. The same calculation can be done either in Excel or in financial calculator. So what is accrued interest? Accrued interest means when I sell a bond at a time between two coupon dates, then there would be some interest applicable since the last coupon payment. So that is called the accrued interest. So when I'm selling or buying a bond, I will have the bond price based on the present value of future cash flows. And there would also be the amount of interest that has accrued since the last coupon payment. So if I add the accrued interest to the bond price, it becomes dirty price. If we exclude the accrued interest from the bond price, it is called the clean price. So that's all for this lecture. I will continue with the rest of the lecture, rest of the chapter in the next lecture. Thank you.